Small details and small changes can have a drastic impact on the wealth that you ultimately build in retirement. Now, this is the entire focus of our Safeguard Wealth Management YouTube channel. It's why our message, our motto is you don't need more money, you need a better plan. When we change one variable within your retirement, there is a chain reaction effect of changing 30 variables down the line. And so this complex multivariate problem of this changing landscape as we start adjusting variables within your retirement needs to be optimized in order for you to gain the most after-tax wealth. Now, something as simple as how you pay your given taxes in any given year can have a drastic impact, as we will show throughout this video. And we're going to show a specific tax paying strategy and how there can be tremendous value from utilizing this strategy within Roth conversions. Now, we're primarily going to be focusing on this tax paying strategy in the context of Roth conversions. But as you watch throughout this video, you can take concepts from this video and apply it to other areas within your retirement. Now, this video is going to be a little bit more math heavy. It's going to be a little bit more complex. So I'm going to try to walk through it step by step. And there is a specific order and sequence that I'm walking through it in order to help everyone watching this video understand this given tax paying strategy by the time we get to the end of this video. Now, if you end up gaining a lot of value from this video, if you could do us a favor, hit the like button down below, hit the subscribe button. It will help other retirees just like yourself find this video and hopefully gain some similar value from this video as well. So let's start diving into this tax paying strategy. Now, there's an important concept that I want to hopefully thoroughly explain from the front end that will help you provide a framework for how you can view paying taxes at different points in retirement. So as we know, within our retirement plan, there are various points that we can pay taxes and that will have potentially a different effect on our retirement. So for instance, let's use something as simple as a Roth conversion. A Roth conversion is paying taxes on the contribution, if you will. We're paying taxes today, here at the contribution point, and we're avoiding taxes during the growth phase because it's tax protected, tax-free growth within that Roth IRA, and we won't owe any taxes on the withdrawal. Okay, well, the opposite is true when we're contributing to a tax-deferred account. We're not paying any taxes here on the contribution. We're having tax deferral, so we're not paying any taxes here on the growth, but we're paying taxes over here on the withdrawal. And so this tax equivalency concept, we're going to leave out right here this during the growth phase and come back to this a little bit later in this video. But the tax equivalency concept basically specifies that if we're paying the exact same tax rate on the contribution as we would be otherwise paying at the withdrawal phase, those are equal tax equivalent scenarios. So let me walk through a quick example to show exactly what I'm meaning. We're going to be talking in the context of a Roth conversion here. I'm going to make my head just a little bit smaller so we can see the full screen. Now we're going to be looking at a $100,000 portfolio or $100,000 account growing at 7% per year. And we're looking at a 22% tax rate. On the left-hand side of this table, I have a tax-deferred account. This is an account that we're not going to be performing any conversion on. And so this $100,000 is going to grow unencumbered until we end up taking out money at the end of this period, this 20-year period here. Now we can see that $100,000 growing at 7% through time eventually grows to $386,000, almost $387,000 by year 20. But this is a little bit of a mirage here because, again, we know this is in pre-tax dollars. We haven't yet paid taxes. And so when we withdraw this money, let's just assume, again, we're withdrawing it all at one time and paying 22% in taxes. We end up with after-tax wealth here of $301,835. Now let's look at a slightly different scenario here where we're making a Roth conversion in year one. And so we're paying our 22% in taxes right off the bat so that we never have to pay taxes again. And what you'll see here is right off the bat, this $100,000 account goes down to $78,000 because we just paid out $22,000 in taxes because of that 22% tax rate. And we'll see through time, again, this account is still growing at 7% per year, but now we're looking at all after-tax values. So by the time we get to year 20 and handle the same situation of translating this to after-tax value, we can see that these end up being tax equivalent scenarios. No matter when we're paying this given tax, when the growth is tax protected, okay, if we're paying that same given tax, we have a tax equivalent scenario. Paying 22% on the contribution results in the same after-tax wealth as paying 22% on the withdrawal. And so the whole point of Roth conversions is your goal is to pay taxes at a lower rate than you will end up seeing throughout your retirement. So for instance, the Tax Cuts and Jobs Act, the 22% bracket is turning into the 25% bracket in 2026. So if we can make a conversion today and pay 22% to avoid 25%, now all of a sudden we've broken this tax equivalency idea and we're paying less in taxes today than we will end up paying in the future. Now the Roth conversion makes sense. And so this tax equivalency idea is pretty simple when we're just looking at two scenarios. We're looking at a tax deferred account or a Roth account, and whether a conversion makes sense today versus a conversion or withdrawals in the future. But we know we have more tax buckets in retirement, or many of us have more tax buckets in retirement. There's a third tax bucket called a taxable account. Okay, this is an account where you don't have that same tax deferral. You don't have that same tax-free ability. You pay taxes on the money to contribute to this given account, and then on an ongoing basis, you may owe additional taxes if you create a taxable event. Understanding and utilizing these tax buckets properly is where we start to see some benefits come from this tax paying strategy that we're eventually going to be talking about. And so when we go back to this bucket equivalency example, again, we know that contribution and withdrawal, if we're paying the same exact taxes at both points and we're having tax protection during this growth phase, those are equivalent scenarios. The problem is when we start looking at a taxable account, when we're having to pay taxes during the growth phase, this is where we see this tax equivalency idea break down. So when we look at a taxable account, when we're paying taxes on an ongoing basis during this growth phase, we start to lose value. We start to leak value from our retirement because the taxes that we paid can no longer compound and grow on our behalf. And so let's go through a scenario here. We previously just recorded a video actually earlier this week talking about tax drag within your taxable account. Now we talked about it in terms of a dividend, but whether you are having dividends within your taxable account, whether you have capital gains coming from a mutual fund, whether you're making a change within that taxable account, which is translating to a taxable event, all of these things cause your taxable account to have a given tax drag. So let me explain this a little bit more in depth within a table right here. And we're looking at two different taxable account portfolios here. We're looking at a taxable account with no tax drag, and then we're looking at a taxable account with a tax drag. And I'll try to explain these as thoroughly as possible. I'll also link in the upper right-hand corner to this video that we're referencing, the increasing cost of dividend tax drag, so you can have a little bit more context as to what we're talking about here, specifically relating to dividends. We're going to first look at the left-hand side of this table right here. Now, this is a taxable account with no tax drag, meaning that, let's say this person is investing in year one in investment ABC, and they're not going to touch that given investment through the entirety of this 10-year period. It's at the end of this 10-year period, they're going to sell out of this given investment and pay 15% capital gains tax. And so this $100,000, again, we're growing at 7% per year still. We can see grows to eventually $196,000. And so what we're doing here to find the after-tax amount is this person has an original cost basis of $100,000 that when they eventually withdraw this will be tax-free because it's the original money they've already paid taxes on and is invested on their behalf. The $96,715 is essentially tax gain. And so when they sell their given investment and they pay 15% in taxes, they're going to end up with an after-tax wealth of $182,208 here. Now let's look at an alternative scenario where this person has drag within their portfolio. Now we're going to be looking at this in terms of a concept of turnover within their account every 2 years. So basically what this is looking like is they're going to initially invest in, let's say, investment ABC, but 2 years down the road, they're going to switch to investment XYZ. And so by switching, they're going to create a taxable event. And so what we see here is this person paying taxes on a more frequent basis, and it's going to drastically affect the amount of wealth that they have within their given taxable account. And so for instance, in year two, at the end of year two, after they've had 2 years worth of growth, they're going to change their given investment into a new investment and thus have to pay taxes. And so we see that they'll owe $2,174 in taxes based on the growth at a 15% capital gains rate. And we see this through time that they're paying taxes, again, every 2 years here. But notice what happens to the after-tax wealth by the end of this 10-year phase. They have about $4,000 less or $3,500 less in wealth from paying taxes on an ongoing basis. And so let's go through a very simple example where we add the third bucket. Now we're going to look at this with no tax drag. Obviously, tax drag could affect this drastically as we just showed, but we're going to be looking at this with no tax drag here. Exact same scenario we looked at before, paying taxes in the exact same way. Now we're just adding a third account, this taxable account. Now again, in the tax deferred scenario, assuming we never performed a conversion, the exact same math is going to play out. We don't pay taxes right away. We pay 22% in taxes in year 20 to gain our after-tax amount. And we have a taxable account over here that, again, there is no tax drag. It's growing at 7% per year. And in year 20, again, to translate this to the after-tax amount, we are going to discount the growth by 15% or pay that 15% in capital gains tax. Notice when we add these two accounts together, we have $377,498 in total after-tax wealth. Now in the Roth conversion example, we're going to see the exact same answer, but we're going to pay taxes a little bit differently here. Just like we previously showed, we're paying taxes right off the bat. We know what happened there. Again, by the end, we've paid taxes. All of that is tax-free growth, tax-free withdrawal. And so by the time we get to the after-tax amount by the end, it's exactly equivalent to this tax-deferred example. The taxable account, because we're not utilizing this in any given way, versus the tax-deferred example, is going to grow the exact same amount as well. And so we end up with the exact same after-tax wealth, even with adding a third bucket with no drag, because again, we're not using that taxable account in any optimization strategy here. And so this can lead investors to question, is there any benefit to utilizing a taxable account then? We just showed that, again, if we're paying the same rate, we'll have the same value at the end. So previously we recorded a video talking about the optimal way to pay taxes on your Roth conversion. Now to give you the punchline, the answer to that question is paying taxes out of your taxable account. And so I'll link to that video in the upper right-hand corner for a little bit more context, but I want to break this tax equivalency mold right here. And I want to show how when we add in this third bucket, this taxable account, and using that account strategically, we break this tax equivalency mold. And simply said, in the tax deferred account, we're looking at no Roth conversion. Previously, like we just showed, we're looking at no Roth conversion growing at 7% a year. Again, we're taking out 22% in taxes after year 20. In this taxable account here, we're looking at not utilizing this in any form or fashion. We're, again, just growing this at 7% per year. And then at the end, we're withdrawing this given money, paying our 15% capital gain rate. And we end up with that example that we just showed of $377,498, all things totaled and considered. But now when we flip over to the right-hand side of this table, we're making a big change. Rather than paying the Roth conversion taxes out of the conversion, we're paying the Roth conversion taxes out of our taxable account. And so our original taxable account had $22,000. We're going to owe $22,000 in taxes from this Roth conversion. And so what's going to happen is we're going to essentially exhaust this taxable account here and leave the full converted amount left in the Roth IRA. So in a sense, what we're doing is we're transferring money from our taxable account to our Roth IRA by paying the conversion taxes from our taxable account. The money from the taxable account is going right to the IRS, and so we're not having to withhold from that given Roth conversion. So we now have $100,000 in this Roth conversion right off the bat. So now this money is growing at 7% per year, just like in the other cases as well. But interestingly enough, we have $386,968. The same as we have before paying taxes within our tax deferred account. Again, these match up. These make sense based on these compounding rules. But now we don't have a taxable account. The taxable account grew to nothing because we exhausted that right away in that first year. But notice what happens in the difference in the value, after-tax value, in total. We have $377,498 within our tax deferred account with no Roth conversion, but converting at the same rate, that 22% rate, within the Roth conversion and paying the taxes out of our taxable account, we've essentially taken money from a less tax preference account and kept it in a more tax preference account. And now we have $386,968 at the end of this 20-year period. And so by using our third tax bucket, by using tax bucket arbitrage, we're able to break this tax equivalency mode. Again, we're growing at the same rate in both of these examples. We're paying taxes at the same given rate. We're utilizing less tax preference buckets to pay our taxes and trying to gain more within more tax preference buckets, if that makes sense here. And so let's explore what exactly is happening here. If we have three buckets, okay, and we're making a Roth conversion, and we're taking money from our tax deferred account, converting that to our Roth IRA, and we're paying taxes out of the conversion. Essentially what we're doing is we're losing taxes in a tax protected account. We're instead leaving taxes in our taxable account. Now our taxable account, as we just showed, has a tax drag to it. It is a less tax preference account because that growth is not protected. And it can generate unwanted income in the form of dividends, in the form of surprise capital gains inside of a mutual fund. And so it can have other implications within our retirement plan as well. And so really what we're doing here is we're taking money that would otherwise be in a taxable account and we're essentially contributing to a tax-free account, contributing to a Roth by paying the taxes out of the taxable account and leaving the larger conversion going to your Roth IRA. So previously, again, we would have had $22,000 that would have been in our taxable account and not within our Roth IRA. By paying taxes out of our taxable account, we've now essentially transferred that $22,000 inside of our Roth IRA by paying taxes out of that taxable account. So we've essentially transferred money from a less tax preference account to a more tax preference account. And so now let's jump through one more scenario here. So we previously showed that if we're paying 22% in taxes on the conversion versus paying 22% in taxes on the tax deferred withdrawal, if we're paying taxes out of our taxable account, all of a sudden we've just gained extra value with the conversion. We previously just showed that. In our previous example, there was about $10,000 more that was in the Roth conversion scenario by paying taxes out of that taxable account. And so now what we're seeing is we might actually be able to gain a tax advantage, but from potentially even paying higher taxes now to avoid lower taxes down the road. And so let me show you what I mean here. So again, in a tax deferred account, we're still paying 22% here to gain our after-tax value. Nothing has changed over here. Notice there's still $377,498. But now we're adjusting this Roth conversion, and instead we're paying taxes at, let's say, an effective rate of 24.45% from our conversion. And so what you'll notice here is we pay the $22,000 in taxes from our taxable account, but there's a little bit more in taxes that we owe. And so ultimately we see that this Roth conversion results in a little bit less dollars within your Roth IRA moving and compounding through time. But nonetheless, this is all tax-free dollars. So the amount that this ends up growing to is going to be your after-tax wealth. And so what we see through time is ultimately this amount growing at 7% per year, grows to $377,499. Now again, our taxable account is completely empty because we paid conversion taxes right off the bat. And so this $377,499 is our after-tax wealth. And notice this is still one more dollar than previously showed without any conversion. And so we paid more in taxes, 24.45%, when eventually we might be taxed at 22% if we left the money in a tax-deferred account, left the money in a taxable account. And so this is where we start to see, once again, this tremendous value from our tax-paying strategies. So we can see that optimizing the way that we pay conversion taxes or taxes in general will boost your wealth. But we've showed some fairly simplistic examples so far. Note that there are a lot more variables that can be added to this situation that can muddy the waters, but the big message here is paying taxes out of a taxable account can be extremely powerful for your situation. Now, what I mean by there being other variables that we need to overlay into this equation, into this formula here, there are additional variables that can affect whether paying out of that taxable account makes sense today versus the tax benefit that you get paying out of that taxable account. So for instance, the tax drag of your taxable account. Right here, we are looking at there being no tax drag within this taxable account. If this person is paying dividends on an ongoing basis, if they are investing in mutual funds that have capital gains that they're having to pay taxes out on an ongoing basis, this will completely change the math, and you can likely pay quite a bit more in taxes with higher tax drag in that taxable account. Another big one is if conversions push your taxable account rate into a higher bracket. So what I mean by this is, let's say you're maxing the 24% bracket and you're married filing jointly. Well, now you're past the net investment income tax and you're having to owe an extra 3.8% as an Obamacare surtax because of this net investment income tax. So as we assess what your tax situation looks like going forward in the future, you may be able to keep money in that taxable account. And at some point in the future, when your tax deferred accounts have been dealt with, you might be in a 0% long-term capital gain rate. But because of conversions right now, you're being pushed up into a long-term capital gain rate of 18.8%. And so being able to find the break even between, does it still make sense to pay from our taxable account when we're forcing ourselves into higher brackets than we might later see within our taxable account, can obviously change the complexities of this given formula. Obviously, tax risk in the future, they've talked about changes for long-term capital gains. They've also talked about changes and going away with Roth conversions over a given income level. Those tax changes and tax risks, tax hike risk, can adjust this formula going forward in the future as well. And finally, inheritance and estate planning is extremely important to note as well. We've looked throughout these examples as liquidating this account and having to pay taxes. Okay? But we know with a taxable account, as far as the rules are set right now, if you pass this money on to the next generation, you get a step up in basis. So with a step up in basis, you don't have to pay long-term capital gains. Your heirs will essentially receive a cost basis of the market value at the time that you passed away. And so this can obviously change the formulas and what rates we should be willing to pay and what rates we should not be willing to pay. And so know that this is a multivariate problem that will change and have to be tailored to every person's situation based on what they have going on in their situation. But know that paying taxes out of the right accounts can increase not only the value of a Roth conversion, but also the after-tax value within your retirement. Hopefully you found that I was able to wade through the complexities of this concept within this video. Hopefully it was eye-opening for your situation. If you have any comments or questions below, leave them in the comments. We will try to answer them. Always remember, you don't need more money. You need a better plan. If you like this video, please hit the like button down below. Hit the subscribe button. We release videos just like this on a weekly basis. I appreciate you taking the time out of your day to be a part of this fantastic and growing community. We hope to see you in the next video. Have a great rest of the day.